Good afternoon, dear colleagues. We are starting our Q&A session of the 10th season of the CFA Institute Research Challenge, regional season in Russia. So let me introduce the two key speakers of today, Sergei Takhiev, Head of Corporate Finance of ALROSA. He will be probably the main person to answer your questions, and he is the second time with us at our events. First time he was several years ago in his other position in a different subject company, in a different season of the Research Challenge. So today we welcome him back. And please prepare your questions and be as detailed with your questions as you can.
Okay, thank you for the introduction, and I welcome you to this key event. Thanks for your attention. In like 5 to 10 minutes, we will have our Chief Financial Officer to join the Q&A session. Unfortunately, he will have only like 30 to 40 minutes to spend with you. So kind of key strategic questions I would like to pass to him. But just generally, to start the conversation, so we have this. What do you think is the best way, Vladimir, to spend this 5 times well-awaited CFO? Ask the questions, probably you have some generic ones.
Thank you, Sergei. I would suggest that you do your presentation. Whatever you have to say, please take your time and be as detailed as you can. And then just give the floor to the students, and that's it.
Okay. But do we really need to go through the presentation, really?
As much as you wish. Maybe if you want to anticipate some questions, and then feel free.
All right. Just probably 1 hour before this meeting, I had a call with a portfolio manager from London, HSBC, and probably I will go through the key questions she was asking me for 1 hour, and I was answering. So she was new to the company, and she was preparing to invest into the stock, but before she invests, she has to ask all the questions according to the list. So we started from the market fundamentals. So one of the key slides I always show to investors is where we are in the value chain and what are the key components of the diamond sector. The diamond value chain is quite simple from first sight or from first glance. We as a mining company, we are high margin business. I will explain why only high margin business operators can sustain or can operate in this industry. The industry is quite consolidated. Then we have next part of the value chain, extremely non-consolidated business with thousands of small players operating in the sector, called midstream, or the people who cut and polish stones from rough, and then they make polished. In Russian, the rough stone is translated like almaz, and polished stone is brilliant. Those guys who make from almaz to brilliant, we call them midstream. Now, 90% of them are concentrated in India. Why is that? Because there was an incentive from the Indian government like 20, 30 years ago to provide tax breaks to employ people into the diamond business because of the availability of the low-cost, skillful labor. Previously, it was quite labor-intensive business or labor-intensive work. That's why India was scoring one of the best places to produce polished stones. Skillful labor, relatively low cost, tax breaks, and affordable financing from the local banks who were pouring cheap money into the diamond business. That was a situation like 20, 30 years ago. And now the overall infrastructure around the polishing business was built around India. So now it's kind of tradition, very hard to switch from India to other region because there are no incentives for that. And then we have third part of this value chain, diamond jewelry, producers of jewelry and retailers. Again, quite fragmented market, but it's separated or differentiated by the brands. High-end jewelry or branded jewelry is doing well. We see this if you track the statistics of the retailers like Tiffany or Richmond or you name it, the quite well-known players, operators in the market, they show quite decent growth rates. Since 2000, they increased by almost 3 times their revenue, just pouring money in the marketing, and marketing is one of the key drivers of this business. So people promote buy diamond because of number of factors, and people just shift from buying some luxury bags or leather goods or etc. to buying jewelry. So this value chain is relatively simple. You see here rough diamonds, polishing, and diamond jewelry. And the value chain, again, let me introduce our CFO, Alexey Filipovsky, who will spend with us like 30-40 minutes. And I would suggest at this part of the presentation, we can actually stop because we discussed the market conditions and how the value chain was built and why in India was concentration of polishing business and mining is concentrated, etc. So we can ask questions to CFO, just saving time. And then we can proceed further with some slides of the presentation, or we will use the slides of the presentation when we illustrate our answers. You feel okay? What do you think, Nikolai? Who will be the first?
Yeah, I think that's a good idea. Thank you. Just one thing. When you're asking a question, you're pressing the button, and then please make sure that you're speaking close enough, but not too far. So I'd say like 10 centimeters, 15 centimeters from the mic. And then when you're done,
Good morning. Good evening. Yeah. I have a question about your marketing strategy concerning millennials. How are you going to work with them, and is it any diversification between their consumption of diamonds and consumption of our generations? Thank you.
There were lots of talk about consumption of millennials and how it differs from the consumption of generations before that. What we saw is that millennials, they're just young. They just don't have that kind of disposable income to purchase diamonds for that to be comparable to the consumption habits of older generations. So in fact, we believe that diamond is a symbol of love, and it will stay true to future generations as well.
Thank you.
I guess, the biggest difference is that millennials like to buy through internet. And if you look at the channels of sales channels for ALROSA, and especially for jewelry retail, you will see that the penetration of internet at this point is rather low. It's at about 10% of overall retail sales. Going forward, we expect that it will grow aggressively and should reach about 25 to 30% in 4 to 5 years. So that's probably the major difference. Different channels to buy diamonds. Thank you.
If I may, can add that our marketing, including Diamond Producers Association, they conduct on a half-year basis perception studies among various generations and the target groups. So millennials are no different from other generations. And also we should bear in mind that the diamond jewelry is not for everybody. So the 7 billion people is not the key consumer base. So if we divide very roughly, I had a question just out of the box from an investor who was asking me how many people buy every year diamond jewelry. If we divide like 70 to $80 billion market by average selling item, which is 3.5 thousand dollars business, so we have quite a handful of people who is a key audience for the diamond jewelry market. Certainly, it's a very rough estimate and should not be applied very in our marketing campaigns, very straightforward. But again, it's quite a thin segment of the market.
Thank you very much for your detailed answer. I would like to ask another question. Do you plan to develop as a mining company mostly, or do you also plan to develop your downstream and midstream divisions? Because our team saw a concept of business transformation in one of your investor presentations, and we wanted to ask you what do you mean by a business transformation, whether you have plans to develop into a vertically consolidated, vertically integrated company. So this is the question.
We saw many examples of Russian metals and mining companies diversifying outside of Russia or into different areas of business, and very few of them were successful. So we learned this lesson on others' mistakes, and going forward, we want to stay very boring mining company in a diamond mining business. We do have some exposure to midstream. We have our own polishing arm, and we recently acquired Smolensky Crystal. That's the biggest diamond polishing plant in Russia. But we have no further plans to expand in this area as the current exposure gives us enough information. I mean, the whole purpose of having midstream, this small portion of midstream for us, is to understand the economics of midstream. So the current exposure is giving us sufficient knowledge of the economics. No plans to enter retail. It's totally different business. No plans to acquire something abroad. And our vision of business transformation is to focus on efficiency. For many years, historically, ALROSA was isolated from like real world by its high margins. There was a notion that if we are making so much money, then we must be very efficient. Which was not true. It was we were efficient. We were making money not because we were efficient, but because our mineral base is absolutely unique, and we were just monetizing it. And also we were isolated geographically and still are. 29,000 people are located in Yakutia, and ALROSA in Yakutia is just it's like a country within a country, государство в государстве. That's what we are, and unfortunately, over the years, not enough modern practices were reaching ALROSA, and now we have a catch up to do. So our transformation is to focus on efficiency. Also, one of the most limited resources for ALROSA is the managerial resource. We can only do so much. So, and given that we have so much potential in our core business, which is in expanding or raising efficiency in diamond mining, it would probably be speaking economically, NPV negative project for us to divert that limited resource elsewhere, be it abroad or be it in other types of businesses or for vertical integration.
Thank you very much.
I'll ask one question which is coming in from other universities which are not in Moscow. And then you can, after my question, then you can go on with your questions, okay? All right, so let me see. Sorry about that. I don't think I can ask this one. Yeah. How does the growth of the synthetic diamonds market affect your activity?
We believe synthetic diamonds will be positioned in a different segment of the market. If you look at the overall global jewelry market, it's around $300 billion, and only 85 billion out of it is diamond jewelry market. So there is plenty of room where synthetics could play. And I have to say that for anyone who is just, entering this industry, the diamond industry, when they learn about synthetics and the expansion of synthetics, it really looks threatening. It looks like, this is like a real disruption that will change the industry forever. But as you grow more familiar with the nuances of that business, you understand that you begin to realize that synthetics is more like a distraction rather than disruption. And there are a few reasons for that. First of all, synthetic diamonds and natural diamonds, they are very similar. If you look at the physical or chemical or optical characteristics, they are very similar. They're pretty much the same, but they're not identical. There is an equipment that is available at every stage of the diamond value chain that could, with 100% certainty, tell synthetic diamond apart from a natural diamond. And as long as it's the case, I think the threat is very limited. In addition, when synthetic diamond producers started to aggressively promote, market, and advertise their product, they were building their promotions on kind of mouth-washing the natural diamond industry. They were positioning synthetic diamonds as an eco-friendly, ethical, blood-free alternative to a natural diamond. It is simply not true. If you look at for example, at the carbon footprint of a natural diamond comparing to a synthetic diamond, most of the synthetic diamonds are made in China using coal-generated electricity. And the carbon footprint of 1 carat of synthetic diamond is about 540 kilos per carat, which is huge. And it is times more than that for a natural diamond. So to make a shorter answer, it is a distraction, but not a disruption for our business. And going forward, I think the outcome of the competition between synthetic and natural diamonds will be very similar to the competition of synthetic and natural rubies, for example, that played out in the 70s. Very similar situation. The technology became available in early 70s, very similar promotion and marketing. Look at it today. Synthetic rubies are making about 2 to 3% of the market in terms of dollars, and the price difference between a natural ruby and a synthetic ruby is about 10 times. And I think that's where we will end up with synthetic diamonds. Circumstantial proof to my words is the ever-increasing discount between synthetic stones and natural stones. 2 years ago, it was in the range between 10 to 15%. Today, it's about 80 to 85%. So, and I think this is a very, very strong proof that market and consumer sees it as a different product.
Thank you for your answer. Very clear. Thanks.
Probably to add to that, I just bumped in when I was reading a newspaper about the aluminum industry. I read that in 19th century, aluminum was one of the most expensive metals, and even were jewelry made of aluminum until the process of producing aluminum from bauxite was invented, and that's now became just one of the cheapest metals in the industry. So people pay for rarity and scarcity of the resource, just to highlight the special feelings or special attitude. That's the bottom line about the LGLD, I guess.
Continue the topic of lab-grown diamonds, and given the threat possessed by these type of diamonds and the entry of De Beers into this market through the launch of Lightbox, does ALROSA consider their opportunity to enter this market of synthetic diamonds too, and why? Thank you.
No, there are no plans to enter synthetic diamond industry. If you look at what De Beers did, they actually did disruption of the synthetic diamond industry. And the reason they've done it is because they saw exactly what I was saying earlier, that, that synthetic diamonds producers were trying to promote their product by telling lies about natural diamonds. So it was a defensive move, and if you look at the market positioning of synthetic diamonds produced by De Beers, it's very simple. It's very commodity-like. There are 3 sizes, quarter of a carat, half of a carat, and 1 carat. 3 colors, linear pricing. For example, half of a carat is twice cheaper than 1 carat stone, which is completely not the case for natural diamond industry. No certification and no grading offered. So when they launched that their brand, the Lightbox, it was in May of last year. It happened on the 2nd or 3rd day of a big Las Vegas trade fair where synthetic diamond producers were promoting their product. Couple of days after the promotion, more than half of the orders were cancelled because no one knew what would happen with the price. Also, then, a very important part of Lightbox marketing is that the price is fixed. It's $800 per carat, while a comparable 1 carat stone of natural diamonds is between $4,000 to $6,000 per carat. And the reason why we are not entering this business, because after De Beers did it, we don't have to. Only one player in the industry had to do it.
I have some questions regarding your capital expenditures and cost. So previously it was mentioned, but that capital expenditures this year will be around 28 billion. And recently the guidance was reduced to 23 billion. This decrease was driven mainly by the lower capex in Verkhnemunskaya and Udachny, and will the company continue the strategy of decreasing capex in the development of mining capacities?
If you look at our capex structure, roughly 15 billion rubles per year out of it is like the ongoing maintenance capex, replacing the aging equipment or maintaining the mining capacity. The rest consists of some efficiency or social projects that vary from year to year. The change for 2019 was mostly driven by our revision of our production plans for 2020. Our original production guidance was about 38 million carats. Now we revised it down to 34.3. And the reason we did it is because we will have about 23 to 24 million carats in inventory at the end of this year. So even if the market recovers aggressively in 2020, in any case, we can afford producing 34 to 35 million carats in the next couple of years. So we are just not investing in replacing the equipment at some of the capacities that we decided to shut down for the next couple of years. So that was the main driver.
Thanks. And one more question regarding your capital expenditures. How much capex is planned to be spent on the restoration of the Mir mine? When is ALROSA planning to put the mine into operation, and what is the estimated production level? Thanks.
Mir mine, I'll just quickly remind that Mir mine was, the accident happened in the end of 2017, in August actually. It took us about a year and a half to find a technical solution that would make restoration and relaunch of Mir mine possible from the industrial safety perspective. That was the key concern for us. So currently the approach is to build another deep shaft and come to the ore body from below and mine it from bottom up, leaving a large isolating level between the flooded portion of the mine and the portion that will be mined. It will be an expensive project. Currently we see that the capex will be in the range between $1.3 to $1.6 billion, with the time to build at about 7 years. However, if the grade, if the ore grade at the deep horizon of the mine, body, of the ore body that will be mined, will be the same as it was in the flooded portion, this project will generate more than 20% of IRR. So it will be a very, very NPV positive project. The decision to reconstruct the mine will be taken at the end of the next year after we finish the deep drilling that we are doing right now to verify the grade at those lower portions of the ore body. Before that, we just do not have enough information because it totally depends on the grade in the lower portion of that kimberlite pipe.
Thanks. And we understand that the sale of non-core assets is a part of ALROSA strategy, and the reports of ALROSA indicate that the book value of this the reports of ALROSA indicate the book value of these assets and what are their market values?
You know, it really depends. It depends on the assets. For example, last year we sold our natural gas assets in Western Siberia. I think the book value was originally it was about 58 billion rubles. We sold it for 30 billion rubles, but it was still, you know, pretty good given the time that the asset was originally bought. Most of the assets of non-core assets that we have on our books that haven't been sold yet are pieces of real estate located in some remote parts of Yakutia that frankly nobody needs. So most of them are worthless. We would prefer to sell them because if you don't sell them, then we would have to, you know, to destroy them and then recultivate the land. That we will do if we find no buyer, but whatever we could sell, we'll sell. You know, the short answer is that you should not expect any significant proceeds going forward from the non-core asset sale.
Okay, I understand.
Big exception, by the way, is our utility business in Lensk. That's the business that provides utilities like heating and water purification services for the population. That will be divested earlier next year. There are a couple other assets that we call non-core, but we will not dispose of them. There is the airline and the hydropower electric station. We are totally dependent on both of those assets, and we will keep them.
I understand. Thanks for your answer. So the last question, it's about your cost control. So by what means the company is going to stick to the strategy of cost control? As it was mentioned previously, the volumes of alluvial processing will be decreased. By how much and how long will the strategy last?
When you're talking about the strategy, you're talking about this temporarily decrease in production or like a very long-term strategy to keep costs in line?
So the second one, keep costs in line.
Keep costs in line. You know, going forward, we will have a larger share of underground mining versus open pit because, you know, open pit are being exhausted. That will increase costs, but it will also increase yields. There will not be a substantial difference in cost because of that. But generally, you know, it's just looking at most of the cost control is based on looking at the drivers of costs, and that is productivity of personnel, productivity of equipment. For example, we are looking at KTG. It's coefficient that tells you the proportion the equipment is ready to work versus like the all time. Currently, that metric for ALROSA is at around 85%. The best practice that we see in Russia is 92 to 93%. So we still have room to improve. Same is with the efficiency of the usage of equipment. For example, like the turnover on the big trucks, whether the truck is standing idle when the driver is taking lunch, or whether there is a substitute driver that is operating the truck and the other machinery. So currently we are doing a few projects with a company called BCG, Boston Consulting Group, looking at the potential to improve our efficiency. And I think this is like a never-ending work. You master one technology, then a new technology will appear. If you are talking about mining, especially underground mining in 10 to 20 years, I think humanless technology will play a big part, because it is much cheaper to send a robot underground rather than to send a human underground. Most of the costs are driven by industrial safety and security. So if you have a robot, you don't have to worry about a mine floor collapsing or something like that.
Okay, let's to let everybody ask questions, let's only have one question per person, all right? So can someone raise a hand from this side and then have one question, and then another team asks another question, all right? Thanks.
Good evening. My question is partly related to the previous ones, and it's related to the exploration policy of the company. Actually, the ratio of exploration costs to the EBIT of the company is 3 or 4 times higher than the peers have. Could you please comment on this expansion policy and perhaps give some details of such state of affairs?
I think it depends on location. Frankly, I'm not familiar with these metrics for our peers, but my guess is that it could be driven that Yakutia is the area that is quite mature from the point of exploration. It's been explored since the 50s very aggressively. ALROSA by itself is investing between $50 to $60 million per year in exploration. There are 2 types of exploration. There is an exploration of existing capacities, and then there is like a greenfield exploration. I'm talking about greenfield exploration right now. We have to do it pretty much no matter how much it will cost, because that's the future of the company. It's becoming harder and harder to find new kimberlite pipes that bear diamonds. And it's not just the case of ALROSA. The same is in Canada, the same is in Africa. So the exploration cost per carat will rise, and if you want to stay in this business, we just have to do it.
Thank you.
Mm-hmm.
Hello. One small follow-up question about the mere capital expenditures. Is it, the amount that you mentioned, more than $1 billion US dollars, is it included in your capital expenditures guidance?
As I mentioned, we are doing some deep drilling. The deep drilling for 2019 and 2020 is included. It's about $15 million per year. The big capex is not part of it, because the decision has not been made yet.
So may I proceed with the main question I wanted to ask? So I would switch a little bit to Africa. So in recent years, the Katoka, as a main stakeholder in Russia, it made substantial capital expenditures, and in 2018, it was said that the capital expenditures will be more than $300 million US dollars. So in addition to 100 already spent. So such capital expenditures, they affect the free cash flow of Katoka, without doubt. So, then I would divide the question into several parts. So first of all, everything is related whether you expect that the dividends that are paid by Katoka will increase in the upcoming years. The first, do you think that the final stage of huge capital expenditures in Angola is over, and it will be over in 2020 or 2021? and so that it will add up some additional substantial amount of money available for dividends? That is the first question. Okay, probably, yeah.
It's still under discussion. All of this African story for ALROSA is still evolving. As we speak, our CEO is on the plane to Angola just to discuss our stake in Luash. Our current view is that we would like to have a controlling stake in Luash. At this point, we cannot secure the controlling stake because Angolan government would like to have an ownership structure where they have a controlling stake and the remaining stake is more or less evenly split between Chinese, Middle Eastern, and Russian investors, while ALROSA would be doing all the work to develop the deposit, which is something that we do not think is fair. But we keep talking. Just in 2019, there were 2 meetings between Mr. Putin and the governor of the president of Angola to discuss the ownership share of ALROSA in Luash. Speaking about the capex, if we do get a controlling stake in Luash, we would be willing to finance all of the capex. It is a very good deposit. It is the last major deposit that was found. It will take about 5 years to bring it up to speed. It could produce up to 8, potentially 10 million carats per year, totally substituting the volume of Argyle that will come off stream in 2021. And the capex will be about $100 million per year. We expect that most of this capex will come out of Kataka dividends.
Okay, thank you. And may I
You
proceed?
already asked the question. So
Yeah, but okay.
is that a follow-up or a
Yeah,
different
it's
question?
like a flow of
Okay, go
questions
on,
relating
sorry.
to
Go on,
Katoka,
go on.
probably. So recently it was allowed by Angolan government that the domestic producers, they can sell up to 60% of their production to the free market, and they expect that such barrier would be dismissed in recent future because such a 60% barrier, it allowed to increase the average selling price a lot for Katoka, and it actually, I suppose it greatly increased revenues.
Yeah. I mean, I think this was the biggest driver behind the improvement in their financials in 2017 and 2018. I think it was the biggest change brought by the new president of Angola. So we are welcoming this move. We were pushing for that to happen. And I think as the Angolan government will become more comfortable with the transparency of Katoka and Luash sales processes, they could remove that 60% restriction as well.
And when do you expect it to happen?
I have no clue. It might take a while.
Okay.
But this 60% restriction is also a very, very big step ahead.
Yeah, of course. So I have one small question.
No, I said one question
Okay.
per team.
Okay.
Yes, you can ask after other
All right.
other guys ask questions. All right.
Good evening. Regarding your strategy, price over quality, will you revise your strategy if the industry stagnates for a while? And how do you connect that with the efficiency first strategy? Thank you.
There is a great book called The Rise and Fall of Diamonds. It's about the monopoly of De Beers, and it's pretty much about the whole history of the diamond industry. The diamond industry was always regulated by supply. So it was always price over volume approach, and De Beers was very successful there because if you look at the history of diamond prices, when De Beers maintained its monopoly, it was gradually rising. So diamond was viewed as a very, very secure investment. Speaking about ALROSA today and De Beers today, we both feel that maintaining this price over volume approach would be a sensible way to move forward. because as the strongest part of the diamond value chain, there is upstream, there is midstream, and there is retail. We are the strongest player. We maintain responsibility for the integrity of the whole value chain. However, if you look at some shorter period of time, for example, going into the next year, we believe that it would make sense to, at least for the next few months, to move to volume over price strategy, because the price went down substantially from the beginning of, from the middle of 2018 up until today. And given that both De Beers and us, we built a substantial inventory, we need to offload that inventory into the market. So what we are doing, we are adjusting production, and we see that we will not be rising prices if the market recovers until we are able to move volumes into the market. But longer term, I think it will, strategically, it will stay price over volume. It is a scarce product. I think the overall situation with the exploration success is very supportive. The last major diamond mine that was found by ALROSA, I think it took place in 1996. So it's just becoming harder and harder to find new diamond-bearing kimberlite pipes, which justifies the continuation of this price over volume strategy.
Probably to add to that, you just look at how the oil market works. If we reduce prices and push more volumes, that will not make you to buy more diamonds. So there's a limited space on the woman to put more diamonds. And once the price deflates, that means that the retailers who have to cover the fixed costs, like marketing spending, rentals, etc., R&D, and online promotion, sales channels, promotion online. So they will have to increase turnover, meaning that reducing prices, they will have to push more volumes to the market as well. That's why I'm saying that there's a limited space to put diamonds on. So probably it sounds like a joke, but that's it. Yeah, reducing volumes, keeping the price higher, you retain the overall balance of the demand, final demand, and the supply.
Thank you for having us today. In 2018 annual report, ALROSA reports diamond production by division, both in carats and in dollars. Can you please explain the way you calculate your production by division in dollar amount?
There is a price list that is set and updated by the Ministry of Finance, called Preiscourant price list, that is used to calculate the mineral extraction tax. So essentially, there is a certain price that could be attributed to all kinds of any kind of diamond, depending on the quality and size. So what we do, we measure the output, and then we define the overall value of production based on those prices. And those prices are updated once or twice a year. Mm-hmm.
Can I also add to that? We will quite soon we will update our price list and cost base by the division, and we will upload it on the website. I guess it will take like a couple of weeks. I think it will be helpful for you to include into your models for modeling. And if you have any questions, you'll always have a chance to ask us as investor relations to comment on the cost dynamic and price dynamics as well.
I have a question concerning the revenue. Well, we know that sales of ALROSA has dropped significantly in 2019. So what's your outlook on revenue or sales of rough diamonds for the future years?
Our legal department forbids us to give exact numbers. But I can say that in 2020, our expectation is that we will be able to sell between 37 to 39 million carats at about the same price index. The mix should improve. My expectation is that it will improve by measuring to the average price of 2019. It will improve by $7 to $10 per carat. driven by the fact that in 2019 the demand was mostly driven by the smaller stones categories, and the index will stay the same. And you can do your calculations based on that.
And to make a long-term calculation, probably you can look at the correlation between GDP and final demand for diamond jewelry. So that's also helpful. So R square is about 0.9 correlation between the diamond jewelry sales and USA GDP. US is 50% of the total diamond jewelry demand. Yeah, so that's probably could be also a helpful indicator for you.
Yeah, longer term, I believe that the diamond prices will grow a bit faster than inflation, driven by, first of all, the higher share of disposable income, the emergence of middle class in India and China, and the ever-increasing scarcity of diamond mines.
Thank you.
Could you please clarify company's policy about its leverage? Is company going to issue new debt, including bonds or bank loans? Thank you.
Our target leverage is between 0.5 to 1.0 net debt to EBITDA. That's where we feel comfortable. The optimal leverage for the company from the point of minimizing the cost of capital is about 1.7. However, our shareholders would like us to preserve our investment grade ratings, and that is not really compatible in Russia today with 1.7 net debt to EBITDA. So that's why we will be staying between 0.5 to 1.0. In terms of the new debt issuance, we do have a target maturity profile, debt maturity profile. It's between 2 to 3 years, and that means that we should, at any given point, we should have roughly 2 benchmark size Eurobonds outstanding, as we have now, and the rest we usually get from the 1 to 2 year loans from foreign banks operating in Russia. This way we are able to decrease our cost of borrowing. Currently, for our Eurobond, it's 4.65% for the bond that we issued in April, and the short-term debt, I think we have $600 million of shorter-term debt. Today, the average rate is between roughly about 2.9%.
Okay, so talking about the bonds, how do you plan to pay off the Eurobonds until 2020? So that's the next year. And will your dividend policy suffer due to that payment?
No, dividend policy is driven by our free cash flow. So paying down the dividend is not part of the free cash flow. So we expect that we will be able to finance the repayment of this $500 million Eurobond that is maturing in November of 2020 by our operational cash flow and some smaller sized debt borrowing for 1 to 2 year periods. And then most likely we'll be back on the Eurobond market in early 2021 to refinance those shorter term loans.
Thank you for your answer. I've got a question about the Zimbabwe project. Could you please comment on the status of the project and about your expectations, and is the investment there is paid off or not, and what are you going to expect in the forthcoming years? Thank you.
Zimbabwean government is, I would like to say that they're quite aggressive in pursuing foreign investment in the country these days. However, they're offering very good terms. For example, unlike Angola, they're willing to have us 70% shares in the new ventures, which is pretty good by African standards. However, if you look at the Zimbabwean track records related to property rights, it's very poor. You know, they had some bad examples of how to treat foreign investors in the past. And that's number one. Number two is that the political stability in Zimbabwe is also questionable at this point. So we will take a very cautious approach to our investments in Zimbabwe. Currently, we agreed that we will invest between $2 to $5 million in the new greenfield exploration projects in 2020, and then we will see how it goes. And not just the exploration, but also the overall political and property rights environment in Zimbabwe.
Before you leave, I have a lot of questions coming in, and several of them have the environmental theme. So people are asking if, just the font's too small, if there's idea among the management of issuing some green bonds, and does the company plan to increase the share of its ecological expenditure in revenue? For the last 5 years, it didn't exceed 2%. And how do you evaluate the impact of ecological trends on ALROSA's market cap? Thanks.
Environment and, especially environmental issues in finance are becoming visibly more and more important. We feel that. We actually have a meeting with Goldman Sachs in a couple of weeks to discuss this green bonds market. So I do not have an answer yet, but this is something that we are looking at. In terms of the share of our investments in the environment-related projects, I think going forward they will increase. Although I have to say that ALROSA is a very clean company. Most of our power is produced by hydroelectric station that we own, or by natural gas facility that we own. Both are the types of clean fuel. However, there is always more to do in that area. And this is the area that will increase its relevance going forward. We totally support this, and the company will be ready to invest whatever it takes to preserve our reputation as a clean company.
There's also a follow-up question on this theme. It's how do you plan to fund these future ecological expenses? Is there
From
anything?
operating cash flow. The company is generating lots of cash. Whatever we don't invest goes to our shareholders, so it's a very simple business model. And environmental expenditures will be part of that cash flow.
Thank you for your answers. And turning to the sales channels of ALROSA. Recently, company has developed the new channel of sales through private clients of bank. Could you comment on what is the share of such sales, and do you find and see any risks associated with this new channel, since they hold diamonds in investment portfolio is not provide the liquidity?
It's still emerging. It's at the very early stages. I actually went to a couple of those sales events. They're very interesting. You look at those people who buy diamonds for each other. There is lots of interest, but I think it's more like an experiment at this point rather than a mature sales channel for us. So we do meet with VTBs, Bearbank, Raiffeisen private clients, and the banks are also very supportive because it shows that they can offer them something special. But I think it will be a while before it will become a mature sales channel.
Thank you.
So one more question about the sales channel. We know that 70% of ALROSA sales are through the long-term contracts. And can you tell how these contracts work, and namely how frequently the price is revised, and is the quantity fixed completely, or counterparty has an option to purchase only fraction of the volume? And another question is, for what volume current contracts are settled, and when do they mature?
Mm-hmm. Yeah, this was for me probably one of the most surprising aspects of ALROSA business when I joined the company. The way it works is that it's very difficult to become a customer of ALROSA, same for De Beers. you have to pass through a certain beauty contest where each applicant has to prove that they have lots of money, they have great reputation, they've been in this business for centuries and so forth. Once the customer is selected, then the customer has to sign a binding contract where they have to purchase a certain volume of ALROSA product at a price set by ALROSA. So this is really unique. The all power is at the producer stage. However, given that most of the purchases are coming from the midstream, and I think Sergey mentioned that midstream is quite vulnerable to external shocks because there are very low barriers to entry, significant working capital requirements, and lots of players. Sometimes, as for example it happened this year, we find ourselves in a situation when it would not make sense from the long-term perspective to really push those sales to our customers. When this happens, we relax those off-take requirements and allow our customers to purchase, let's say, not 100%, but 70% or 60% of the contracted output. For example, today, this number stays at 55%, and this is the lowest it's been in many, many years. Last year, it was varying between 70 to 80%, but generally, we give our customers some leeway on how to purchase, and all of the contracts are prepaid. So when the customer has selected the stones they want to buy, they have to pay within 5 days.
Okay, thank you.
Good evening. Thank you for this brilliant opportunity. I've got a question concerning India, who happens to be one of the major polishers on the diamond market. And as we know, it faces now some financial problems, in its financial sector. And what are your plans to mitigate these problems?
Excellent question. If you look into the key reasons for the current slowdown of the diamond market, I believe that the major reason is the banking sector crisis in India. I don't know how much you know about this, but there was a whole financing channel called non-banking financial companies and BFCs. The way the channel worked is that they were getting money from the state banks and then issuing credits to smaller businesses, including many of the polishers. Essentially, all of the credit risk was passed to the state banks, and those NBFCs, they were trying to drive volumes. So essentially, it was a bubble. That bubble burst in the end of 2017. As a result, about $3 billion of external financing had disappeared from the polishing market. And next step, this $3 billion disappeared from ALROSA and De Beers sales. That is happening in 2019. That's like the origin of the current slowdown. What's happening today? I think the market is slowly recovering. There are lots of money in the world today, and this crisis results in some capacities changing hands. However, we believe that most of the modern capacities, will stay operational, and longer term, this cleaning of the industry will be beneficial. As you know, those guys who were playing this financial engineering games, they will exit the business.
Thank you.
I apologize, I have to go. I have another meeting. I would like to say it was a pleasure to see so many bright young people interested in ALROSA. I would like to add that, we are always looking for good people, especially those willing to spend some time in Yakutia. Yakutia is a very interesting region. So please, if you're interested, drop the resume, and we're always looking for good people. It was a pleasure talking to you. Thank you.
So it's not an end game, so we can proceed with questions.
So we have another hour, 45 minutes, and I'm sure you guys have a lot more questions. If you're not asking, then I got questions coming in from other students.
Hello, we have already discussed product mix improvement in 2020, and do you expect any reasonable opportunities for the improvement in a couple of years or in longer term?
I a second. Где у нас highlights? Страничка. Исторические highlights. Вот. Да. Yeah, okay. So how I view the product mix changes here. So I see the 24-month cycle for this sector. For example, one of the illustrative years was 2017 when we saw the prices going down because of the mix, mostly. So people were buying small stones. They were replenishing stocks. And then 2018 was the year when was a high demand for larger stones. So according to the market, we will be offering our products. So this year was a year for smaller stones. If you look at our price index, it was down by like 10% this year, but average selling price was down by about 20%, meaning that 10% was due to the just overall like-for-like price decrease, and mix effect was another like 10%. I joined this company like 1 year ago, 1.5 years ago, and for me this concept of new prices was a bit new. I was working for a steel company, and for us the prices were more or less visible. You can go into on Bloomberg and see HRC price and slabs, etc. And here it's completely different. So we have actually two concepts of prices: like for like index price, which is a comparison of kind of production mix, what we dig out of soil and produce, and we compare those stones on a like-for-like basis, just to get an understanding where the real market demand is. And there is a second concept of average selling price, which is revenue divided by volumes, which includes mix change and in index or like-for-like price mix change, for like-for-like index change. So that's probably very. I guess you noticed this, but again, just to reiterate, we're talking about the same concepts. Index was down quite significantly this year. Average selling price was down even larger than that, like 22% year to date. So 12% was due to the mix impact. As I said, this 24-month cycle, meaning that 12 months of 2019 was the period for smaller stones. Next year is going to be the period for larger stones. The whole cycle, if we take like polishing process, it's like 9-month cycle for those guys. So they buy stones, they pay for the stones cash, they bring it to the facilities, they try to polish it, and then they try to sell it to the final customers. It takes about 9 months for one stone. The ratio coefficient from rough stone to polished is somewhere around 0.48 to 0.5. So from 1 carat of rough stone, you can produce 1 carat of polished stone. It's not linear. Sometimes it's like 5 carat stone can bring only 2 stones of 1 carat. So it's not so simple and straightforward, but for simplicity reasons, you can use this coefficient of 0.5 of yields. For jewelers, it takes about, or for retailers, it takes about from 9 to 12 months to sell the jewelry set to the final customers. So if you bind it together, so you would get the idea that it's about 24-month cycle, really. So for next year, mix should be better, because now the market is full of small stones.
I have a follow-up question about prices. Recently, De Beers they lowered their prices for products, and would you implement the same move to your pricing strategy, or would you remain prices the same? Thank you.
Okay, like the difference between us and De Beers, they are part of Anglo American, a public company who is not extensively report. You probably noticed this. Report the monthly sales volumes and monthly prices or quarterly prices. So in our case, we do report on a quarterly basis, and that's why the market already sees our pricing strategy, that we decrease our prices, but let's say 10% year to date. In their case, they do not announce the price decreases, so sometimes they offer price discounts or any other mechanisms which are not clearly stated, publicly stated by the company. So that's why my guess is they corrected the price just according to the real price in November. So the price decreases for both us and De Beers, they go hand by hand, so more or less they are the same. They just reflected the reality in the price announcement.
Thank you for your answer.
Thanks.
Switching the discussion to the whole industry, since China is the second largest consumer diamond market, what do you expect would be the effect of continued protests in Hong Kong on the whole industry, and how can you estimate this impact? Thank you.
Yeah, okay. It seems that the Hong Kong protests coincided well with the growth in sales in mainland China. So mainland China sales, they more or less compensate for what was lost in Hong Kong. Due to the more relaxed import duties in China and let's say repatriation of demand in mainland China, the demand for diamond jewelry is growing there. In mainland China, tourists flows decrease from China also impacted the growth in mainland China. For example, normally tourists from China, they went to United States, they just for kind of leisure and some business visits, and in airports they were buying diamond jewelry because of the tax reasons as well, or like very emotional manifestation of ending of the trip or just beginning of the trip. Devaluation of yuan and some tensions between China and the United States impacted negatively tourist flows into the United States. So Chinese stayed at home and they were willing to spend money they were just willing to spend elsewhere. So we feel that one would compensate for another. So overall Chinese demand would be, who knows, probably 2-3% down on a yearly basis from all-time record levels. But recent statistics, even today, we see that there is a growth in mainland China, which probably will bring by the end of the year the overall diamond jewelry demand down up to kind of zero change. So there is a positive dynamics now. First half of the this year was down, was negative. But it seems the demand is catching up.
Thank you.
Well, going back to prices, and if it's possible to return the slide with the prices, please. How could you account for such a leap in prices in average selling price in 2018, please?
It's a mixed change. So 2017 there was a quite significant decrease, in both in 2016 and 17. Collectively, it was you see that it was a 21% drop. If you add those 12 and 9% drop. That would come both from index price decrease and mix change. And 2018 was the year of the compensation for that. Plus, it was a very strong demand for diamond jewelry. In 2018, the diamond jewelry demand reached an all-time record levels, somewhere around up to $80 billion. There is also quite interesting feature here. So nobody knows how much diamond jewelry is purchased every year with a kind of 100-degree certainty. Recent De Beers Insight report, which I would recommend to you to read, shows that De Beers revised their estimates about the diamond jewelry consumption, so by almost $10 billion downwards. So it now stands at about $76 billion. And we are actually in two minds how to assess the market ourselves. So probably most likely we'll come up with the new estimates as well. That happened because of the revision of the US statistics backwards. So again, sources of statistic sources also changed their statistic estimates.
Thank you.
Could you please tell about production outlook? Because in a recent presentation, the company's outlook was decreased in 2020 from 38 carats in old outlook to 34 in the new outlook. And the question is, what is company's outlook about production in 2021 and in recent future?
About the future plans, we're not ready to comment because we don't know what's going to be the market going forward. If market recovers, so we can easily come back to the projected numbers we put on our slides, like 37.7 or even higher than that. So so far we have not decided. But for the next 12 months, we revised our plan, production plan. So the decrease it was due to the revised plans on alluvial deposits. So actually we have three types of deposits: alluvials, underground, mining, and open pit. So underground is up to 80% fixed cost, so there is no big sense to reduce operations there because you, at any case, you will incur the costs. So we can continue to run those operations. Open pits, probably 50 to 60% fixed cost anyway. So we have some flexibility to reduce operations there. And the alluvials, they are like 50% and below fixed costs versus variable costs. And those are the first candidates to be switched off when the demand is going down and you have excessive inventory at hand. So we actually took this decision, and this decision should be taken by the end of the year, because when slowdown happens, we have very limited flexibility in the middle of the year because already supplies are delivered. That explains, so supplies, raw materials, spare parts, they are delivered to the mines, and there is no sense to just switch it off because you already incurred the costs. Like, it's almost like a sunk cost. But by the end of the year, when we approve the plans and when we approve the supply and purchasing program, yes, we have a flexibility to, or like an option, either to stay where we were before or to reduce our production plans. So by the end of the year, we decided to cut the plans, and officially it will be taken probably in a couple of weeks, I guess, the 34.3. And that allowed us to reduce our costs by 150, I guess, $1 million, this decision, because of the variable cost reduction, and also reduce our CapEx program because of that.
Okay. Thank you. I've got a question on the inventories. If we will assume the same like-for-like prices as we see it now, what is the average selling price of your inventories? And the other question is whether you expect that the inventories will be decreased by roughly 3 to 4 million carats a year, and what is your target level of inventories, which you are comfortable with? Thank you.
Okay. About the first question, you can actually deduce yourself what's the average price for the inventory, because we do not disclose this information. It's commercial, it's price sensitive, etc. Our salespeople will be pissed off, and same as the compliance department. But it's kind of a bit easy to calculate. If you take an average price adjusted to the mix change last year, which was $140 by the end of the year, that's the average kind of price adjusted to the mix. And then you can apply the both index price and average selling price. You would come up with the average price at inventory we have at hand. For example, $128, that was the average selling price this year. But since the index was down by 9% or 7.5% in these numbers, and average selling price by 22%, meaning that 12% decrease was due to the mix change. That means that your average kind of inventory price should be higher than 128. So it's kind of a very simple exercise you can do. The second question about the inventory, comfortable level of inventories. By the end of the year, since we have some very strong seasonality patterns when it comes to the operating rates. So during the summer, from March to 8th of October, depending on the weather conditions, we run alluvial deposits. We have some inventory for the winter season. So by the end of the every year, we have some 118 million carats on average. By the end of this year, we would have 23 million carats. I think the comfortable level for this company to run operations, the minimum is like 9 million carats. And during the hot season, when the production is high, and during the slowdown, it's kind of like 14 to 15 million carats, just give or take. So we have some excessive, like minimum 7 million carats, which could be sold without debottlenecking operations or speeding up the operating rates at the facilities. So that's the key source of the working capital release for the next several years, I guess.
So you mean it will take from 2 to 3 years to come to the comfortable level, right?
Yeah, it depends again on the market. If the market is not recovering, there is a little probability of this chance, but again, it could happen. So yeah, we can continue to bring those inventories down or kick the can down the road, as we say. But the good news about the diamonds, they're not bananas, so they not get rotten or spoiled. So we can put them in vaults, and it's almost zero cost storage item. So once it's up and not polished, it's washed and in the vault, so you can store them for ages.
Okay, thank you.
Okay, if there are no questions, and then I'll ask a few questions that I received. I think you already mentioned about the vertical integration in ALROSA, right? Before? I can't remember that. The question is, do you plan to make complete vertical integration in the company? Okay, well, these guys then don't know yet. Okay.
You can see this on the diamond value chain.
All right.
That the diamond mining producers, they have high margin business. So we have guys in the middle who have, you see that, $26 billion of sales and like 1 to 3% of margins, meaning that they bear all the working capital costs. Yeah, and barriers are low. Retail business is a separate business, is a consumer-driven. Yeah, we're comfortable with.
Any hints at M&A?
Only divestments. We purchased of non-core businesses, but I don't think we have a lot of non-core operations to sell down. We have some, small-scale businesses just to pass to the local governments or to sell in an auction like real estate. Today was a news that we're selling an asset, an office building for 1 billion rubles. I guess by the end of the year it will be finalized, but again, could be next year. About the recent purchase or acquisition of the asset, we purchased Crystal, a polishing business, with like $200 million of revenue per annum. 88% of costs are related to the rough diamonds purchase. 90% of the supplies comes from ALROSA. So actually, in terms of accounting, you will see some revenue growth, but at the expense of reduction of accounts receivables of our company. According to the Russian law, after the WTO inclusion, rough stones, they used to be sold at export duty. When the export duty was abolished, the local polishers, they faced this fierce competition with international peers. So, and they asked for some, delayed payment, and it was passed by the government to allow them delayed payment for the rough stones. That's the only exception or exclusion from the overall sales patterns or sales practices we have. So no material impact on our financials, I guess, for this business. Net asset positive, so we paid 1.8 billion rubles for the business. That's kind of it.
According to international standards, you should have 5 independent board members, but you have 4. Is the company going to increase the number of independent members? And how do you see this as a potential risk?
Good question. Russian corporate governance practices, which were adopted by the Russian regulators, they're actually complying with the international requirements. So the best practice could be, increasing the volumes up to 100% or, whatever. So we have what we have actually. They represent the nominees from the Russian Federation, Republic of Yakutia, including the local communities as well as independent directors with international experience. And we have good practices here with 2 out of 3 committees being chaired by independent directors. Last year, our company was recognized as the best corporate governance company with the best corporate governance practices by East Capital International firm, who invests into Russia. It's a Sweden-based entity who conducts such rankings. So the practices are one of the best, I guess, in Russia, or the best in Russia, and one of the best globally. So I don't think it's adding or just removing one of the directors dramatically will change the overall kind of governance practices of the company. Sometimes the numeric approach is not the best one when it comes to the governance practices. So the interests of the stakeholders are aligned. So we have actually 3 parties here: minorities, Republic of Yakutia and local communities, and Russian Federation. And everybody is interested in both long-term value creation and sustainability of the operations, including ESG or environment, social and governance practices, sustainability and good practices. as well as dividends. So if we have good projects, certainly our shareholders would approve the investing into the high return with good proven economics projects, which would not undermine any health and safety or environment or aspects. If there are no such projects, we design a new dividend policy, which allows us to float the cash in the form of dividends to shareholders. And as I always say to the shareholders, let it be your headache what to do with the money, because that's actually their money, and we are not an asset management here. So no project, here you go, you got dividends.
One more question concerning the risks. Well, we've looked over the ALROSA's reports, and saw a drop in revenue over the year 2016, as far as we see, it hasn't yet recovered. How would you account for this drop in revenue, and what are your outlooks for diamond price and the company's revenue in 2019 and the forthcoming future?
It would not be very original to say that revenue is a function of sales volume and average selling price, which again is a function of the demand for the product, and this demand is driven by both fundamental factors like growth of the middle class, as well as marketing efforts of the company and of the association of the diamond producers. So I cannot provide long-term guidance on the company performance. It's actually your task to express your view. We can here provide you all the kind of ingredients. If we make a kind of analog for restaurants, so we actually providers or suppliers of the materials for you. You cook yourself your models, and you cook yourself your projections. So I would refrain from answering you directly this question. I can tell you what's going to be with our kind of what assets we have and what could be the production outlook. What's the stock level comfortable, and what are the key underlying demand drivers for the industry, and how we are planning to promote our sales through marketing campaigns, bringing the newer initiatives like promoting ALROSA brand, because lots of, apart from Tiffany, Graf, LVMH and others, there are lots of a big gray pool of jewelers who cannot afford aggressive marketing campaigns. What we're actually trying to do here is to replicate what Intel was doing. For example, the no-name computer assembler who is using Intel chips inside. They just say, okay, Intel inside, and sometimes you don't care. You care about the price, but if you want a high-quality computer, you don't care about who was assembler. You care about the content of ingredients of this computer. The same approach we're trying to promote here, to promote our brand for the small jewelers, without high kind of firepower to promote to market the brands. One of the approaches to promote this style. Others is targeting the new customers. Someone was asking about the millennials and new generations. They are conscious about the sustainability, and they are willing to buy the products which are not harmful for the environment and for the people. We here have huge competitive advantage over our peers. We have a single source production. Everybody knows it comes from Yakutia. We produce this in a clean way. We have local communities sitting on the board, and we have local employment. So meaning that we have very good oversight of the sustainability, or how proper our operations are run. So we have lots of things to showcase that our production is sustainable. So we invest into wildlife, we invest into the local people, in the medical services, in employment, etc., and building infrastructure everywhere where we come. The new way to promote the company and sales is to promote digital passports of the stones. So when people buy the jewelry, they can actually download the story about the diamond, where it comes from, even the person who was actually polishing it, and etc. So, and that's already a new new marketing tool we have, or we started to use this year, and we test right now with retailers how they can integrate it into their sales systems, and what can be the price premium for this product. So sometimes it can be up to 10 to 15% price premium over the rest of the stones. So yeah, we have the tools to maximize sales, to cut costs, but the volumes will be certainly according to the market dynamics.
Thank you.
I have a question about taxes. In your 9-month financial report, you wrote about problems, issues with Russian tax legislation, and what there is a chance that you could get additional tax charges. And if it happens, it could significantly impact your P&L. Could you please explain, maybe numerically, how much is this significant impact?
I don't remember exactly the tax problems in the financial, I mean, saying the problems with the tax there. The company is paying the mineral extraction tax, which is calculated as revenue based on the price list of Ministry of Finance and the bonds we sell, and also the profitability tax. With since we report IFRS, sometimes there are some delayed tax payments, and we're catching up in the fourth quarter with the tax payments. So that probably you refer to this this issue. Apart from that, we don't have any kind of a delayed tax payments or tax assets we can recover or just write down. So nothing particular here. The only issue is that since the profitability is going down, so we pay less taxes. But again, that's understandable, I guess.
Thank you.
It was said by Angolan officials that the maximum capacity of Katoka is approximately 12 million carats a year, but it is currently 8 to 9 million. So when the level will be attained, first of all, and secondly, what are your expectations on the future dividend payments by Katoka? Thank you.
So in other words, should you model 12 million carats from Katoka, and what should be the dividend proceeds, I mean cash payments from Katoka in your model?
Yes, you're right.
Okay, so 12 million carats, that can be the maximum capacity. But again, the market probably does not require so much stones. So I would, if I were you, I would just put a flat number. And dividends would be depending on the market, on the price for the stones, and the proceeds they get from selling the stones. We receive dividends with sometimes 12 months delay. So for this year we would receive, from 2018. The share of dividends we are receiving for now, it's like 33%, kind of old number. This year we increased our share ownership up to 41%. So starting from next year, I guess you would see the increased volumes of dividend proceeds from Angola. So I would put like $40 to $50 million of dividends to be on the safe side. Probably could be some upside to this number, but again, as Alexei told you, that sometimes it's unpredictable, or can take time, as he said.
Thank you.
As we know, around 30% of share capital is owned by the Russian Federation, around 30%, another 30% is owned by Yakutia, and around 40% is in free float. So the question is whether we can expect any changes in share capital structure in the near future.
No, as far as we know, no changes.
All right, so should we have 2 more questions and then wrap it up? Cool.
So it was also recently discussed about the profitability of your mines in Arkhangelsk region. So under current prices and assuming the probably, as you said, some upside potential in the prices for 2020 and for the upcoming years, is it possible that we'll see that you will close the several mass division? Thank you.
You mean we close it, shut down?
Yeah, because the Господин Moiseev from the Ministry of Finance, he said that for the last 3 to 4 years it was well discussed whether whether the profitability is good or bad for the several mass, and it was discussed probably whether it should be closed or not. So can you comment something on that, please?
What we officially show here is several mass is included into the long-term production outlook, so it's growing. I think the cost versus price, the spreads between the cost and price, they are quite narrow for the asset. But I don't think it's a base case scenario where we see the several mass being closed forever. So I don't think it's on the cards, on the table.
You mentioned that ALROSA plans only divestments in non-core assets, but my question included their ALROSA acts as a government, kind of government in remote areas such as Yakutia. So you have airplane company and so on, assets in transport. Do you plan to increase your expenditures on those like social infrastructure? And what role do government subsidies play in those expenditures, if any? Thank you.
The social capex is about 6 billion rubles. That's a cap. So that was a decision made a couple of years ago by the management, just to put the cap on the social expenditure. What comes above the $6 billion should be approved on the board level. And you know that we have our chairman of the board, who is a minister of finance. So it will be something extraordinary if some big projects, social projects, would be taken to the board. Apart from that, I don't think there is a big risk of social capex expansion, because the local governments and Yakutian local governments, they own the third of the company. First, they have taxation, taxes which remain there in the region, and also they have a high level of locals employment, so personal tax or salary tax, and also they have flow of dividends going to the region now. So the dividends increased by several times over the recent years. So they have a new source of funding of the infrastructure, etc. So I don't think this is the risk for the company. So I guess the status quo will be maintained.
All right, thanks everyone. Thank you, Sergey, Dmitry, and Alexei has already left. The questions were very interesting. I hope you all, got to understand a little bit more and December 16th, we'll be expecting draft reports. That's in a month. Again, Sergey, thank you.
Okay. Thank you.